We've just observed a sharp price move above a well-defined resistance level, only to be met by an immediate and aggressive reversal. This type of price action negates what appeared to be a breakout and, from our perspective, requires a deeper institutional analysis.
So why does this matter? Well, this isn't random. It's a recurring pattern, one specifically engineered to trap breakout traders. At the same time, it signals the true positioning of institutional participants. Identifying this pattern can give you an edge in anticipating the market's next major directional move.
The primary driver behind this price action is the institutional hunt for liquidity. It's important to understand that price isn't moving by chance. It's being deliberately directed toward a very specific objective, accumulating or distributing large positions.
Think about it. Large capital can't just enter the market with a single order without dramatically affecting the price. So instead, institutions have to manipulate price to access pools of orders, specifically the stop-loss orders of other participants. This allows them to fill their positions without causing significant slippage. This really reinforces a core concept here. The market is, fundamentally, a mechanism for transferring wealth. It's engineered to facilitate institutional objectives, and it uses the predictable behavior of other market participants as its primary source of liquidity.
And these liquidity pools, well, they aren't randomly distributed. They tend to cluster in very predictable locations, exactly where traders are commonly taught to place their stop-loss or entry orders. So naturally, these are the precise zones that institutional algorithms are engineered to target.
All right, let's deconstruct this reversal. When you break it down, you'll see it's actually a logical, repeatable process. And this sequence is what exposes the underlying institutional activity.
The cycle typically begins with quiet accumulation. This is followed by a deliberate manipulation, the stop hunt, which is designed to engineer liquidity. Once those large institutional orders are filled, the market then moves, and often quite forcefully, in its true intended direction.
Because this reversal happens so aggressively, it often leaves behind what we call inefficient price delivery. On a chart, this is visible as an imbalance, or a fair value gap. This gap literally represents a void in the market where one side of the order book was completely overwhelmed.
Now, these imbalance zones often act like a magnet for price. The market has a tendency to revisit these areas to rebalance and mitigate orders before it continues on its main trajectory. For informed participants, this behavior can sometimes offer secondary points of entry.
This pattern is potent, no doubt, but any serious analysis has to account for uncertainty. So we must define the risks and the specific conditions that would invalidate this entire thesis.
And here's where we see the key divergence in analysis. Retail participants often view this move as a confirmed breakout, a clear signal to buy. At Crypto Intel, our analysis frames it very differently. We see it as a potential liquidity grab, which is a reason to pause and wait for confirmation of either price acceptance or, as in this case, a sharp rejection.
So what would invalidate this liquidity sweep thesis? It's simple. Price acceptance above the level that was breached. If price were to consolidate up there, it would suggest the initial move was driven by legitimate buying pressure, not a stop hunt.
Understanding this mechanism has a pretty significant strategic implication. It fundamentally shifts how you should view market structure and those key price levels you see on the chart.
So the core takeaway is this. Obvious support and resistance levels are not rigid barriers. They're better viewed as targets, dynamic zones of interest where institutions are likely to engineer price moves to facilitate their own objectives.
This price action analysis provides one critical data point, but the unresolved forward-looking question is this: how does this activity correlate with positioning data from the derivatives market? A convergence of signals across those datasets would provide a much higher degree of confidence in the analysis.